Here is a mistake that hundreds of thousands of Canadian dividend investors are making right now, and most of them do not know it. They hold U.S. dividend stocks, Johnson & Johnson, Coca-Cola, Realty Income, inside their TFSA. It feels logical. The TFSA is tax-free, so the dividends from those U.S. stocks are tax-free, except they are not. When a U.S. company pays a dividend to a Canadian investor, the U.S. government withholds 15% of that dividend before it ever reaches the Canadian account. The Canada-U.S. tax treaty reduces this rate from 30% to 15%, but 15% is still 15%. Inside a non-registered account, that 15% is partially recoverable through the foreign tax credit on your Canadian tax return. Inside an RRSP, the Canada-U.S. tax treaty eliminates the withholding entirely. 0. The RRSP is the one Canadian account where U.S. dividends are fully protected. But inside a TFSA, the 15% is withheld, and the CRA does not allow a foreign tax credit recovery. The 15% is gone, permanently, every quarter, on every U.S. dividend payment, on a $200,000 U.S. dividend portfolio inside a TFSA yielding 3.5%. That is $7,000 in annual dividends. At 15% withholding, $1,050 disappears every year. Over 15 years with reinvestment, that lost withholding and its compounding costs approximately $26,000. The TFSA is the best possible account for Canadian eligible dividends. Completely tax-free. It is the worst possible account for U.S. dividends, and most Canadian investors have it exactly backwards. This video explains the full comparison: which dividend stocks win for Canadian investors, which accounts they belong in, and how to structure a dividend portfolio that captures the best of both. Before comparing yields, growth rates, or total returns, the tax treatment of Canadian versus U.S. dividends for Canadian investors is the foundational difference. Getting this wrong costs more money than almost any other dividend investing mistake. Canadian eligible dividends, the tax advantage. When a Canadian resident receives an eligible dividend from a Canadian corporation, Royal Bank, Enbridge, Fortis, the dividend tax credit significantly reduces the personal tax rate on that income. The effective tax rate on eligible dividends at the Ontario top marginal rate is approximately 39.3% versus 53.53% on interest income. This is a genuine, meaningful tax advantage for Canadian investors. Inside a TFSA, Canadian eligible dividends are completely tax-free. The dividend tax credit is irrelevant because there is no tax at all. The gross dividend flows directly into the account with zero deduction. This is the optimal treatment for Canadian eligible dividends, and the reason the TFSA is the ideal account for holding Canadian dividend stocks. Inside a non-registered account, the dividend tax credit applies, making Canadian eligible dividends more tax-efficient than interest or U.S. dividends at equivalent pre-tax yields. U.S. dividends received by Canadian residents, the withholding tax reality. The United States taxes dividends paid to foreign investors. Under the Canada-U.S. tax treaty, the withholding rate on dividends paid to Canadian residents is 15%. This withholding occurs at the source, before the dividend reaches the Canadian investor's account. Account by account, TFSA, 15% withheld. Zero recovery. The 15% is permanently gone. This is the worst possible treatment and the most common mistake. RRSP and RRF. Canada. U.S. Tax Treaty. Article 21 provides a full exemption for dividends paid into a recognized Canadian retirement account. Zero withholding. The full dividend flows into the RRSP. This is the optimal treatment for U.S. dividends. Non-registered account, 15% withheld at source. However, the Canadian investor can claim a foreign tax credit on their T1 return, recovering some or all of the withheld amount depending on their personal tax situation. The 15% is not permanently lost. It offsets Canadian income tax owing. The practical summary: Canadian eligible dividends, best in TFSA, good in non-registered. U.S. dividends, best in RRSP, acceptable in non-registered, worst in TFSA. With the tax framework established, here is the pure investment comparison: yield, dividend growth rate, track record, and sector exposure. The yield comparison: Canadian dividend stocks typically offer higher current yields than their U.S. equivalents. The TSX is naturally yield-rich. The Big Six banks yield 3 to 4.5%. Enbridge yields approximately 7%. Pipelines and utilities yield 4 to 6%. VDY, the leading Canadian high-dividend ETF, currently yields approximately 3.8 to 4.2%. U.S. dividend aristocrats typically yield lower on a current basis. Coca-Cola approximately 3%, Johnson & Johnson approximately 3.1%, Procter & Gamble approximately 2.4%. Realty income is the exception at approximately 5.5% to 6.0%. If current income is the primary objective, Canadian dividend stocks generally win on yield. The dividend growth comparison. This is where U.S. dividend stocks assert a meaningful advantage. The U.S. dividend aristocrats, companies with 25-plus consecutive years of dividend increases, have historically grown their dividends at approximately 6 to 10% annually. Some dividend kings, 50-plus years of consecutive increases, have grown dividends even faster. Canadian dividend aristocrats have a lower minimum threshold, just 5 consecutive years. While standouts like Fortis, 52 years, 4 to 6% growth, and Royal Bank, historically 7 to 10% in normal years, have strong records. The breadth and depth of the U.S. dividend growth universe exceeds Canada's significantly. The Rule of 72 applied to dividend growth. At 8% annual growth, a U.S. dividend doubles in 9 years. At 4.5% Canadian average, it doubles in 16 years. After 20 years, the lower-yield U.S. stock with faster growth has often surpassed the higher-yield Canadian stock in absolute dividend income. The track record comparison: U.S. dividend kings, companies with 50-plus consecutive years of dividend increases. Examples: Procter & Gamble, 68 years, Coca-Cola, 62 years, Johnson & Johnson, 62 years, Colgate-Palmolive, 61 years. These are dividend streaks through the Great Depression, World War II, the 1970s inflation, the 2008 financial crisis, and COVID-19. Canada's longest streak: Fortis at 52 years, a genuinely impressive record that places it among North America's elite dividend growers. Canadian Utilities at 51-plus years. But the depth of the U.S. dividend king universe, over 50 companies, exceeds what Canada can offer at that level of consistency. The sector exposure comparison. This is the Canadian dividend investor's most significant structural limitation. The TSX's dividend payers are heavily concentrated in financials, energy, and utilities. A Canadian dividend portfolio is implicitly a Canadian banking and pipeline bet. U.S. dividend stocks offer something the TSX cannot: dividend-paying companies in technology, Texas Instruments, Microsoft; healthcare, Johnson & Johnson, Abbott; consumer staples at global scale, Coca-Cola, Procter & Gamble; and industrial conglomerates, 3M historically, Emerson Electric. Genuine sector diversification in dividend-paying stocks is a U.S. advantage that Canada structurally cannot match. Here is the vault, the specific account placement rule that changes the after-tax return comparison completely, and that most Canadian dividend investors have exactly backwards. The rule is this: match the asset to the account that treats it most favorably. Canadian eligible dividends are treated most favorably in the TFSA, where they are completely tax-free. U.S. dividends are treated most favorably in the RRSP, where the Canada-U.S. tax treaty eliminates withholding entirely. This sounds simple, but the implications for a Canadian dividend investor with both a TFSA and an RRSP are significant. The optimal structure, TFSA, VDY, XDV, Canadian bank stocks, Enbridge, Fortis, Royal Bank, CN Rail, any stock paying Canadian eligible dividends. The dividends are completely tax-free. The dividend tax credit is replaced by complete tax elimination. RRSP, VYM, U.S. High Dividend ETF. Individual U.S. dividend aristocrats, Coca-Cola, Johnson & Johnson, Procter & Gamble, Realty Income, any U.S. dividend-paying stock. Zero withholding tax under the treaty. The RRSP is the only Canadian account where U.S. dividends are fully protected. Non-registered, overflow of both. Canadian eligible dividends get the dividend tax credit. U.S. dividends get the foreign tax credit. Not as efficient as the registered accounts, but better than the reverse placement. Why most Canadian investors get this backwards? The TFSA feels like the ultimate tax-free account, so investors put everything into it, including U.S. dividend stocks. The RRSP feels like the serious retirement account, so investors put it into Canadian bank stocks and dividend ETFs, thinking conservatively. Both are backwards in a dividend context. The specific improvement from correcting the placement. A Canadian investor with $100,000 in VDY in their RRSP and $100,000 in U.S. dividend stocks in their TFSA, switching these two positions eliminates the 15% U.S. dividend withholding tax and optimizes the Canadian eligible dividend treatment simultaneously. On the numbers described earlier, the withholding tax saving alone is worth approximately $1,050 per year on a $200,000 U.S. dividend allocation, compounding to approximately $26,000 over 15 years. For a pure income investor, dividends are the primary objective. For a wealth-building investor, total return, price appreciation plus dividends, determines which approach actually builds more wealth. The total return comparison changes the picture significantly. The 10-year total return comparison. Over the past decade, the S&P 500 has delivered approximately 12.5% to 13% annually in USD terms, and closer to 13.5% to 15% in Canadian dollar terms as the loonie depreciated against the USD. The TSX has delivered approximately 8% to 9% annually over the same period. Even specifically comparing dividend strategies. U.S. dividend aristocrats have delivered stronger total returns than Canadian dividend equivalents over the past decade. The combination of dividend growth plus price appreciation has favored the U.S. side. Why this matters for dividend investors. A dividend investor who focuses only on yield often misses that the price of the underlying stock matters for total wealth. Enbridge at 7% yield is attractive. But if the stock price declines 15% while paying that 7%, the net result is a -8% total return. A U.S. dividend aristocrat growing its dividend at 8% annually and also appreciating in price delivers compounding that yield alone cannot capture. The currency tailwind for Canadian holders of U.S. stocks. Over the past decade, the Canadian dollar has depreciated from near parity with the U.S. dollar to approximately 72 cents to 74 cents. This has added approximately 1 to 3% annually to the returns of U.S. stocks held by Canadian investors. On top of the underlying USD performance, a Canadian holding Coca-Cola in their RRSP has received both the Coca-Cola dividend growth and the CAD depreciation tailwind. When Canadian dividend stocks win the total return argument, the TSX's value-oriented, resource-heavy composition means it periodically significantly outperforms the S&P 500, particularly during commodity supercycles, high inflation periods, and when interest rates rise sharply. In 2022, when the S&P 500 fell approximately 18% and technology stocks fell 30 to 50%, the TSX fell only approximately 5.8%, with Canadian banks and energy stocks holding up well. For income investors who cannot tolerate large drawdowns, the TSX's stability and high current yield provides genuine value. The honest answer on total return: U.S. dividend stocks, particularly the Aristocrats with strong growth rates and global business models, have delivered better total returns over the past decade. The currency tailwind has amplified this advantage, but past returns are not guaranteed. Commodity cycles turn, and a concentrated Canadian bank and pipeline portfolio has provided meaningful income stability that U.S.-heavy portfolios have not always matched. The answer to which wins is not one or the other. The answer is both, in the right accounts, with the right proportions for your specific objectives. Here is the practical framework for the income-focused investor seeking current dividend income. Primary focus on Canadian-eligible dividends in the TFSA, the highest after-tax income available to a Canadian investor because zero tax applies. VDY or XDV as the core, supplemented with individual positions in the Big Six banks, Enbridge, Fortis, and CNR for those who want stock-specific exposure. Secondary position in U.S. dividend stocks with high current yield, realty income at 5.5% to 6%. In the RRSP, where the 0% withholding under the treaty makes the full yield accessible. For the dividend growth investor seeking growing income over time, U.S. dividend aristocrats in the RRSP, companies with 25-plus consecutive years of 6 to 10% dividend growth. Coca-Cola, Johnson & Johnson, Procter & Gamble, and broader exposure through VYM. Canadian dividend growers, Fortis, Royal Bank, CNR, in the TFSA. The combination captures the long-term compounding power of U.S. dividend growth inside the treaty-protected RRSP. For the total return investor who also wants dividends, XEQT in the TFSA as the primary core, global diversification, 25% Canadian exposure already built in. Canadian dividend stocks in any remaining TFSA room or non-registered accounts. U.S. dividend stocks in the RRSP. The XEQT core captures both dividend income and capital appreciation globally. And the registered account dividend strategy layers income on top. The yield trap check. Before buying anything, always verify payout ratio before buying a dividend stock for income. BCE suspended its dividend in 2024 despite a yield that appeared very attractive because the payout ratio had exceeded 100% of free cash flow. A dividend stock with a payout ratio consistently above 80 to 90% of earnings or free cash flow has limited ability to sustain and grow the dividend through a downturn. High yield without a sustainable payout ratio is not income. It is a pending dividend cut. The one-line summary: Canadian eligible dividends belong in the TFSA. U.S. dividends belong in the RRSP. Both dividend traditions have genuine strengths. Canada wins on current yield and currency matching. The U.S. wins on growth history, track record depth, and sector diversity. A Canadian dividend investor who uses both, in the right accounts, captures the best of both without the unnecessary tax drag of getting the placement wrong. U.S. dividend stocks versus Canadian dividend stocks. The question most Canadian dividend investors ask, as if the answer is one or the other. The real answer is the tax treatment and the account placement. Canadian eligible dividends belong in the TFSA, where they are completely tax-free. U.S. dividends belong in the RRSP, where the Canada-U.S. tax treaty eliminates the 15% withholding. Getting this backwards costs a Canadian investor with a meaningful dividend portfolio approximately $26,000 over 15 years from the withholding tax drag alone. On the investment comparison, U.S. dividend stocks win on track record depth, dividend growth rate, and sector diversification. The U.S. Dividend King universe has no Canadian equivalent in terms of breadth. The dividend growth rates of 6 to 10% annually from companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have compounded to extraordinary yield-on-cost figures for long-term holders. The currency tailwind has amplified U.S. returns for Canadian investors over the past decade. Canadian dividend stocks win on current yield, tax efficiency in the TFSA, and currency matching for Canadian dollar spending needs. The Big Six banks, Enbridge, Fortis, and the Canadian dividend Aristocrats provide income that is completely tax-free in the TFSA, the most efficient income stream available to a Canadian investor. And in environments where the Canadian economy and commodity prices are strong, the TSX's dividend payers have provided stability and income that the U.S. growth-heavy market could not. The optimal Canadian dividend portfolio uses both: Canadian eligible dividends in the TFSA, U.S. dividend aristocrats in the RRSP, and a payout ratio screen before every purchase. Neither wins outright. Both win in the right account.